It's 2009. The bank just gave you a foreclosure notice on your home, and reality is starting to sink in that you're going to lose your family home that you just purchased about 5 years ago. Now, why are you losing it? Well, it could be because the economy took a downturn and someone lost a job in the house, or maybe you, like 40% of all other homeowners at the time, purchased your house using an adjustable rate mortgage and just didn't really understand the financial ramifications of what happened if interest rates went up when that rate adjusted, and how that impacted your monthly mortgage payment. So you're losing your house, possibly having to declare bankruptcy. If this is a story that sounds familiar to you, maybe your parents or a loved one went through it, maybe one of your friends, or maybe even you yourself had this situation happen to you, odds are that if you lived through this time, someone you knew was affected by this housing crisis. So why am I bringing this up? Well, over the last couple of months, some of the most common discussions that I've had with both buyers and sellers have centered around the idea that the housing market is going to crash again, and we're going to see home values in Orange County drop by 30 or 40% like we did back in 2008. And I can completely understand this line of thinking. The last time the housing market slowed down, we saw the biggest housing collapse that we've ever seen in our generation. So it's still fresh in people's mind. It's the first thing they go back to anytime you hear any negative news about the housing market. So that's exactly what we're going to be discussing today. If you're a returning subscriber to this channel, thank you so much for your continued support. I really do appreciate it. If this is the first time you're tuning in, hi, I'm Josh Alexander, your local Orange County real estate agent, as well as host of Orange County Housing Market News, your one-stop shop for all things Orange County real estate. So if you're thinking of buying or selling a home, make sure you hit that subscribe, like, and that share button, because I share tips every single week to help you win in today's market. So on today's episode, we're going to be looking over some of the data and fundamentals happening in today's housing market as opposed to what happened in 2008, so you can get a better picture and idea of what to expect in today's housing market and if you should expect home prices to continue to fall. So let's go ahead and get into it. So if you've watched any of my episodes before, you probably already know where this is going, but we're going to be using the data, the facts, and the current trends in the housing market to give you a better understanding of what's happening and my opinion on what is the most likely outcome for the housing market over the next couple months. So first, we're going to go over all the data and trends happening in today's housing market, and then we're going to take that and be able to compare it and contrast it to 2008 to see if there's any similarities and if we should be worried about a major housing collapse happening again in the near future. So let's go ahead and start talking about what's happening today in Orange County's housing market, as well as most of Southern California. So let's go ahead and first talk about supply, because that's one of the main stories happening in the housing market, not only in Orange County, but through the rest of the United States as well. So right now in Orange County, we have 2,052 homes on the market as of April 20th. Now, just to give you some context, if you look at the 3 years leading up to COVID, which were a little bit more normal years in the housing market, we had an average of 5,780 homes on the market, or 182% more than we currently have right now. So inventory is extremely low in Orange County and in a lot of places throughout the United States, causing a lot of issues in today's housing market, which we'll get to a little bit. So why are we currently seeing inventory go down when typically during this time of year we're seeing inventory start to skyrocket? Well, the biggest reason, and you've probably read about it in the news, is either called a mortgage rate lockdown, golden handcuffs. There's a lot of different terms for it, but basically what's happened is that anybody that purchased a home or refinanced a home during COVID and locked in those 2 and 3% interest rates are having a really hard time wanting to get out and sell their home when rates have doubled, which means their mortgage payment is most likely doubling as well, even to buy the same priced home. And oftentimes, if they want to upgrade, you're looking at mortgage payments almost triple what they might have right now. So for homeowners, there's really a financial disincentive going on right now to make them want to sell their home. So in a traditional market, maybe someone wants an extra bedroom, maybe they want a house with a pool now, maybe they want to move across the city to someplace in a little bit nicer neighborhood. Those type of transactions that we normally see in a healthy housing market are just not happening anymore. The only time people are selling is either if they're selling a secondary property where they're not having to move from one house to another and they're just trying to get rid of a property, or they have a home, they live in it, and there's some major life event that happened that's forcing them to sell. So they're moving for a job relocation, they had another kid and they need an extra bedroom. Those type of transactions are still happening. However, However, the majority of the transactions that we typically see during a normal year just aren't happening right now because homeowners just don't want to sell. They're staying put. They're remodeling their home because they have a giant amount of equity in it instead of actually moving. And it's just creating this lock in the housing market where inventory is just having an extremely hard time going up instead of down right now. And this shortage of inventory is really not going to alleviate itself anytime soon. Until we start seeing interest rates back in maybe the mid-5s, you're really not going to have sellers really motivated to move out of their house because the financial incentives are just not there. So unless rates consistently get back into the mid-5s, you can expect this low inventory environment to continue for the foreseeable future. So what about the demand side of things in Orange County? With interest rates so high, with home prices so high, we should have pretty much no demand going on right now, right? Well, to some extent, yes, we have very low demand happening in Orange County right now. However, demand since the beginning of the year has slowly risen month by month at a time when supply has been going down month by month as well. So even though demand is low, it's about 67% lower than a typical year pre-COVID, supply is just even lower. So there is more than enough demand out there in the marketplace to eat up all the supply in the market, which is keeping the housing market stable and a lot of places in the middle of April starting to go back up again. So the question then becomes, what would it take to get demand so low that we finally start seeing inventory build on the market more rapidly again so we can start to see more housing options to choose from? Well, one of the positive things that have come out of the last 6 months, at least from a data standpoint, is because interest rates have fluctuated more wildly than almost any time in history. We've had rates as high as 7.25 and as low as 5.75. We've been able to determine what the demand is for different interest rate ranges. And if you look at this chart up here, if you're watching it on video, you'll be able to see that as long as interest rates are around the 6.5%, the housing market stays relatively stable. When they go above 6.5% but below 7%, we start seeing demand drop off. But once it goes over 7%, that's when we start seeing a significant amount of demand drop off and inventory start building up on the market, which is what we saw at the end of last year when inventory was building up instead of going down like it traditionally does towards the end of the year. So this basically tells us that as long as we see interest rates hovering around the 6.5% or lower, we're most likely going to have a pretty stable housing market within Orange County where you're not seeing prices go up or down in any meaningful way. If we get below 6%, then you can see prices start going up a little bit faster. If we go above 7%, then you might be able to see prices start to decline a little bit more, again, like we saw at the end of last year. Now, there is one caveat to this. So if you've watched my previous episodes, I talked about this on my April update, but there's a really odd thing happening with interest rates and the housing market right now that you don't typically see. So let me explain. So right now, when we start seeing interest rates go up, yes, demand is definitely dropping. However, at the same time, supply drops as well, because like I talked about before, those golden handcuffs, as interest rates go up, less and less homeowners are selling their home unless they're being forced to. And on the opposite side of things, as interest rates go down, we see more and more homeowners willing to put their house on the market. However, that's met by more and more buyers willing to purchase a home at those lower interest rates. So it seems like no matter what interest rates are doing right now, supply and demand are almost moving together, whether they're higher or lower. So really the biggest thing that's adjusting is how many transactions are happening. When interest rates go up, you have less transactions happening in the housing market. As interest rates go down, you have more transactions happening. However, price-wise, you're just not seeing a lot of differences. Yes, you might see one home over here sell for more, one home sell for less, just depending on the neighborhood. But all in all, we're not seeing major price adjustments happen one way or another in the housing market because of this interesting phenomenon going on right now with both supply and demand and how it relates to what's happening with the interest rates. So speaking of interest rates, probably the second most common discussion that I'm having with both buyers and sellers right now is, where do I think interest rates are headed? Are they going to stop going down and start heading up over the summer? Are they going to continue going down? Well, I don't have a crystal ball. There could always be some world event or US event that happens that dramatically changes what interest rates are doing. But what I can do is go over what is impacting interest rates most right now and where those things are trending to give you the most probable outcome of what you should expect interest rates to do as long as those trends continue. So one of the biggest things that has been impacting interest rates lately has been inflation. When inflation goes up, the 10-year treasury goes up, and why that's important in relation to the housing market is the 10-year treasury is our most accurate predictor of where interest rates are headed. When the 10-year treasury goes up, interest rates go up. When the 10-year treasury goes down, interest rates go down. It's been like that for decades, and it's one of the most accurate predictors of where the 30-year fixed mortgage rates are going. So when inflation goes up, the 10-year treasury goes up, and so do interest rates. However, since the beginning of the year, inflation has been going down, which is also one of the main reasons we've seen interest rates fall since the beginning of the year. So should we expect inflation to go down as we continue through summer? Well, in my opinion, the answer is going to be yes to that. And it's because of something that's really not talked about that often, which is how inflation is calculated, which is the CPI index. When you look at the CPI, did you know that over a third of the CPI has to do with shelter costs, specifically the cost of rentals in the United States? Now, the biggest problem is, even though that we've seen since January, rental costs have been coming down month after month, when you look at the CPI data, you're actually seeing shelter costs go up every single month. Now, why is that? Well, it has to do with the way that the CPI data for housing and shelter costs are calculated. Now, I'm not going to go into all the specifics today. If you want to learn more, reach out to me. I'd be happy to go over it in more detail. But just know that the CPI data typically doesn't show what's actually happening in the housing market for 6 to 12 months after it happened. So usually there's going to be a 6 to 12 month lag on the shelter costs when you look at inflation. Now, based on that, since we started seeing rental prices go down towards the beginning of this year, there's a good chance that we're going to start seeing shelter costs finally start heading down as we head through summer. And because it makes up such a large portion of the CPI data, that's going to act as a heavy weight that's going to continue to help bringing inflation down, even if there's some other categories that go up a tiny bit. Because shelter costs are more than a third of the CPI data, there's a very good chance that inflation is going to continue following, not only through the summer, but as we head through the rest of the year as well. Because again, in real time, we've already seen rental prices fall and we're seeing it continue to fall. It just hasn't shown up in the data yet. So that's something that's going to help continue bringing inflation down throughout the rest of the year. Okay, so we've talked about current supply, demand, interest rates, inflation, but why a lot of you are here is you want to see if there's any similarities of what's happening now compared to what happened in 2008 and 9. So let's go ahead and travel 15 years back in time, look at what happened in the housing market then, what caused the crisis, what caused the housing market to crash, to see if there are any similarities to what's happening right now. So what actually caused the housing market to crash back in 2008? Well, it was a combination of a couple different factors, but let's go over the big ones. So number one, loose lending practices. So like I hinted at the beginning of this episode, 30 to 40% of all loans given out to homebuyers leading up to the housing crash were done with adjustable rate mortgages. So if you're not familiar with what adjustable rate mortgages are, basically the homebuyer is going to get a much lower rate to begin with for a set amount of years, and then it adjusts to whatever the current interest rate is a couple years later. So in this case, as interest rates went up, homebuyers that had extremely low mortgages for a couple years all of a sudden got adjusted up to a higher mortgage that they just couldn't afford. And when you can't afford the payments, you have to sell your home or your house is going to be foreclosed on. Now, at the same time, when all these ARM loans were happening, when you went to actually apply for a home loan, there really wasn't much required. There were loans out there where you didn't have to verify your income, your assets, that you even had a job. You just basically wrote down what you made on paper and they would give you a loan for it. So obviously you can see the problem here. Lenders were giving out loans to buyers that really couldn't afford to make the mortgage payments to begin with. And on top of that, if it was adjustable rate mortgage, it made it even worse down the line when those rates adjusted. This is why we saw so many foreclosures happen and that flood of inventory hit the market, or at the same time, no one wanted to purchase a home. So that's one of the major reasons we saw housing prices crash. However, the blame is not all on the lenders on this. So the homeowners had a responsibility as well, and that came down to how they used the equity in their house. A lot of homeowners leading up to the housing crisis were basically using the equity in their house as piggy banks. They were taking it out, buying RVs, jet skis, doing a bunch of remodeling to their homes. They thought housing prices were going to go up quickly for the foreseeable future, so they saw no problem taking a bunch of money out to do these projects and to buy things they probably didn't need. Now, when all those foreclosures from the bank's loose lending practices started hitting the market and the market started going down, a lot of homeowners found themselves underwater on their properties. So when they had to sell their house, they actually had to pay the lender back money because they owed more on it than it was worth. And so as housing prices were coming down, you saw a bunch of these sellers put their house on the market to try to get their home sold before it went down even more, and they ended up owing even more money on the property, and that just contributed to the inventory going up even more. So just to recap, there were a bunch of adjustable rate mortgages being handed out. There was very loose lending practices. Homeowners didn't have a lot of equity left in their home, and these were all contributing factors to why we had such a big crash that really wiped out 30 to 40% of home values in Orange County. Now let's go ahead and take a look at that compared to where we are today. So let's go ahead and start with the lending side first. So because of everything that happened with the last housing crash and the lender's involvement in it, there were a bunch of new regulations that were put into place to prevent that from ever happening again. They tightened up how hard it is for buyers to get approved for a loan. So basically all you need to know is that in today's economy, ever since the housing crash, it is more difficult than any time in history for a buyer to get pre-approved for a loan right now. So if they can actually get pre-approved, it means that they can afford a property and probably then some. And you can really see how big of a change this made to the entire housing market and how people are approved for loans when you look at things like the Mortgage Credit Availability Index. So how easy it is to get a loan. The higher the number you see on this graph, the easier it is to get a loan. So you can see leading up to the housing crisis, there was almost no regulation. It was extremely easy to get a loan. If you breathed, you can get a loan. Sometimes dogs are getting loans. That's really the worst that it got. You can see right after that, it dramatically dipped and has been low ever since. And you can see that even after COVID, lending standards got even stricter, making it harder for buyers to qualify. So if a lender approves a buyer right now, more than any time in history, they know that that buyer is going to be able to afford that mortgage. So what about the foreclosure side of things? During COVID, there were a lot of people that lost their jobs temporarily, couldn't pay their mortgage, and they went into the forbearance plan. And there were some out there that were saying there was going to be another giant wave of foreclosures as these people exited forbearance because they couldn't afford their mortgage. However, if you've watched this channel at all over the last couple of years, you know that was never the case. There was never any data showing that was going to happen. In fact, an extremely large majority of everybody that exited forbearance either paid it back in full, paid their house off entirely, or they communicated with the bank and they figured out some type of payment plan where they're either going to pay it on the back end or something that allowed them to keep their home. Yes, there was a small portion of those people that exited forbearance that are still not able to afford their mortgage and they will get foreclosed on. However, it's a very small majority and it's really not going to impact the housing market in any meaningful way. And just to give you some more data specifically in Orange County, can you guess how many foreclosures we currently have on the market? 5. And that's pretty typical. We've had anywhere from 1 to probably 8 foreclosures on the market at any given time in Orange County for the last couple years. And even as most of these people have exited forbearance now, that hasn't changed. Yes, they might go up slightly more than that. However, we're still far below the historic norm of the normal amount of foreclosures that we see on any given week or day in Orange County right now. So even if they go up slightly more than that, it's just going to be a normal day in Orange County. And it's not something you have to worry about, this wave of foreclosures hitting the market, all of a sudden dragging home prices down with it. It's just not going to happen. The data is not there. So the last thing on the loan side of things we want to compare are those adjustable rate mortgages. Are we seeing a large portion of all buyers out there using these adjustable rate mortgages, or is it relatively low? Well, again, back before the last housing crisis, we were looking at 30 to 40% of all home loans were adjustable rate mortgages. During COVID, that was pretty much zero because no one needed them. Interest rates were extremely low. We are starting to see those uptick a little bit. Right now, we're hovering right around 13% of all homes, which are adjustable rate mortgages. But the biggest thing I want you to remember as these adjustable rate mortgages start to come back a little bit more is that qualifying for an adjustable rate mortgage is extremely difficult right now compared to what it was back in 2005, 6, and 7. You have to be extremely well qualified, and they're going to qualify you based on a higher mortgage rate than you're currently currently getting. So that way, if rates do go up, they still know that you're going to be able to afford the payments. So the way you qualify for these adjustable rate mortgages is also completely different than what happened back in 2008. And it's all due to those very strict loan standards that have been implemented ever since the last housing crisis. So that kind of wraps up the lender side of things, but what about the homeowner side of things? Do homeowners have equity in their home right now, or are they maxing out and using it as a bank account to do all these type of different home improvement projects or buying RVs again? Well, the good news is that over the last couple years, obviously housing prices have gone up dramatically, and that has increased the amount of equity in a lot of people's homes. Now, it seems like one of the positive things that came out of the last housing crisis is that most homeowners now are not drawing anywhere near the amount of equity out of their home as they used to when they're doing these home improvement projects. So over the last year and a half, we are starting to see more homeowners draw some equity out of their houses again, but not anywhere near as much equity as they were drawing back in 2005, 6, and 7. So yes, people are starting to draw some money out of their homes, but at a more healthy level where if they had to sell their homes, there's still plenty of equity left in the house to be able to sell it for a profit and not have to worry about selling it for underwater. So again, homeowners today have kind of learned their lesson. They are a lot smarter about their equity in general and are not taking everything out of their house. They're taking small chunks at a time, allowing equity to build back up before taking any more. And it's a much healthier housing market because of that. So that brings me to the last point I want to talk about, which is jobs. During the last housing crisis, we did see a lot of people lose their jobs, couldn't afford their mortgage, and had to sell their homes. And today, even though the jobless claims are still very low, they are starting to uptick, so it is something to keep an eye on. However, the biggest difference between back then and now, again, has to do with their equity. If someone loses their job and has $200,000, $300,000 worth of money in their home, they're most likely going to be able to make some type of deal with the bank to be able to defer those payments until they can find another job. And in worst case, if they can't find a job fast enough and are forced to sell their home, they're going to be able to sell their home at market value right now because the housing market is still balanced and strong. So they're going to walk away with a bunch of money in their pocket. If they have to rent for a while before buying another home, they can do that, but they have the financial means to do so, and they're not selling their house at discounts. They're selling it at market value, which is not going to negatively impact the housing market. Yes, some people will lose their jobs. Eventually, some people will have to sell. That's just part of it. However, that number is going to be so tiny that it's really not going to impact the housing market, especially because inventory is already so low right now that it's just going to be eaten up as soon as those homes hit the market. So I know we went over a lot of information today, so let's go ahead and just quickly summarize everything just to make sure it's crystal clear that you understand the differences between the housing crisis that we had in 2008 versus what the housing market looks like right now. So on the supply side of things, right now we have some of the lowest supply that we've ever seen for this time of year. In fact, it's the second lowest it's ever been in Orange County. If you compare that to the supply of 2008, where we had the highest supply we ever saw in Orange County, you can see there is a dramatic difference. Demand is definitely down right now. However, supply is still lower, and that was not the case in 2008. Right now, especially in the price points 1.25 million and below, we're seeing packed open houses, multiple offers. In a lot of areas, we're seeing homes start to go above asking price again. This is all showing that the housing market for now in Orange County is stabilizing, and we're just not seeing those price drops that some have expected. Now, on the lending side of things, if you're a buyer in today's market trying to get pre-approved, it is one of the hardest times ever to get pre-approved as a buyer. Compare that to 2008, where pretty much if you breathe, you can get a loan. Now, in terms of adjustable rate mortgages, right now, only about 13% are actually using adjustable rate mortgages, and they're much better qualified compared to back then when 30 to 40% of all loans were adjustable rate mortgages. And again, very low qualification standards. Almost anybody could get one of those. On the foreclosure front, a flood of foreclosures hitting the market back when we had the housing crisis. In today's market, they're almost non-existent. So on the lending side of things, it's pretty black and white. There's almost no comparisons to be made between what was happening then compared to what was happening now. Now on the homeowner side of things, equity again in today's market is much higher, and homeowners are much more responsible with the amount of money they're drawing out of their house compared to back then, where everybody was using their house as a piggy bank and drawing as much as possible, which again led to a lot of people being living underwater on their home. On the job front, back then, a lot of people that lost their jobs just didn't have the equity in their homes and were forced to sell their home at a discount. In today's market, the equity again is much higher. If people lose their jobs, it's much more likely they can work out a deal with the bank. And if not, because supply is so low, they're selling it at market rates, not below. Now, on the general economic side of things for the US, right now, yes, inflation is definitely higher than it should be. However, it is trending in the right direction. And again, as inflation goes down, interest rates should follow, again, leading to more buyers in the market, more sellers in the market, causing a more healthy housing market and continuing a balanced market for the foreseeable future. So all this information basically brings us back to that question on should you expect the housing market to crash like we saw back in 2008? So based on everything that we just went over, I'm hoping that you can also draw the same conclusion that the chances of that happening are extremely low. However, they're never zero. I don't have a crystal ball. I can't predict everything that's going to happen in the housing market. There could be some type of catastrophe that happens that disproportionately impacts the housing market that no one saw coming. But what I can do is give you all the data, all the facts, and the current trends to give you the most likely outcome of what is going to happen, so that way you can make an informed decision when you decide to buy or sell a home in Orange County. And finally, if you have more questions about the current housing market or what it takes to buy or sell a home in today's housing market, feel free to schedule a 30-minute discovery call with me anytime. Depending on where you're watching this, I'll put a link in either the information or comment section below or in my bio. Feel free to click on it, find a time that works for you. I'd love to continue the conversation and see how I can help you out. So until next week, stay healthy, stay happy, and I'll see you on next week's show. Bye, everybody.